Is your crypto portfolio flashing red, or are you looking at the buying opportunity of a lifetime? Right now, AssetFunds, trading under the ticker ASSETFUNDS, is sitting at a razor-thin price of exactly $0.005405. It is technically up by a microscopic 0.05% over the last 24 hours. The volume is drying up, and the charts look brutal. Almost every technical indicator is screaming sell. Yet, a vocal group of traders in the forums are pounding the table, insisting this token is massively undervalued. Are they visionaries seeing something the market missed, or are they blindly walking into a classic value trap? Let's dive straight into the data. To understand why AssetFunds is dominating the conversation today, you have to look at its core model. The platform was built to bridge the gap between traditional asset management and decentralized finance. The idea sounds flawless on paper, fractionalizing real-world assets so anyone can own a piece of high-yield funds. It is a massive market, which is exactly why this token generated so much hype during its launch. But right now, the project is facing a brutal reality check. The utility of the token hasn't matched the circulating supply, and liquidity has become a major issue. Before we break down the charts, do me a quick favor, smash that like button, subscribe to the channel right now, and leave a comment below with your current strategy. Are you holding, selling, or buying this dip? Your comments keep this channel alive, so let me know your thoughts down there. Now, let's look at the technical analysis, because the charts do not lie. AssetFunds is locked in a textbook descending triangle. The price has been putting in lower highs for weeks, squeezing down against a critical support level. If you look at the moving averages, the 50-day is sloping downward and acting as a heavy ceiling every time the price tries to bounce. Momentum indicators like the Relative Strength Index or RSI are hovering just above the oversold territory. This tells us there is zero buying pressure. The volume profile is incredibly thin, meaning it takes very little selling volume to tank the price, while massive buying power is required to move it up even a fraction of a cent. Short-term strength is completely non-existent here. When you look at the analyst ratings and smart money signals, the outlook gets even darker. Institutional dashboards are currently marking this asset as a strong sell. The negative signals are piling up, particularly on-chain data showing that large wallet addresses, the whales, have been steadily distributing their bags to retail buyers over the last month. When the creators and major backers are trimming their positions, it creates a massive headwind for the asset. The short-term outlook suggests that unless a massive piece of fundamental news drops out of nowhere, the path of least resistance for this price remains downward. This brings us to the ultimate debate. Is AssetFunds deeply undervalued, or is it a dangerous value trap? The bulls argue that at half a cent, the downside is mathematically limited, and the upside potential is massive if the platform gains adoption. They see the current price as a discount. The bears, however, see a sinking ship. A value trap occurs when an asset looks cheap simply because its fundamental value is disintegrating. If a project cannot maintain liquidity or user engagement, a low price doesn't make it a bargain. It just makes it an asset on its way to zero. The downside risks here are immense. Cryptocurrency markets are already volatile, but microcap assets like AssetFunds carry exponential risk. Retail traders constantly get trapped in these setups because they look at the nominal price and think, if it just goes back to 2 cents, I'll quadruple my money. What they fail to realize is that market structure dictates direction. When liquidity dries up, you can experience massive slippage, meaning you might not even be able to sell your tokens at the displayed market price during a panic. Let's lay out the bull versus the bear case. In the absolute best case recovery scenario, the development team delivers a major protocol upgrade, secures a listing on a tier 1 centralized exchange, and locks in a massive partnership. If that happens, short-term speculation could trigger a massive short squeeze, sending the price flying back toward its previous resistance levels. On the flip side, the worst-case continuation scenario is much more likely based on current data. If the support level at $0.005405 snaps, there is a total vacuum of historical price data below it. The price could easily drop another 50% to 80% in a matter of days as automated stop losses get triggered. Looking at the outlook, we have two completely different stories. In the short term, the trend is your friend, and right now, that trend is pointing down. Expect continued volatility, choppy sideways movement, or a sudden breakdown. Long term, the project survives only if it proves real-world utility, and generates actual fee revenue to buy back and burn tokens, without a shift in fundamentals, the long-term chart will eventually mirror the short-term decline. So, where does that leave us? Is AssetFunds a ticking time bomb waiting to wipe out the remaining retail holders? Or is this the absolute bottom before a historic 100 times reversal? The market is at a complete crossroads, and the next major move will catch thousands of traders completely off guard. Which side of history will you be on when the break happens?